In my opinion, I would put anywhere from 15 to 20% allocation in the infrastructure sector and as high as 5% allocation in Larsen and Toubro.
Oh, that's very high. I don't know what the Nifty number is, but I think the Nifty allocation to infra is not as high as 20%.
But it's an outperforming sector, and I love the way the order book positions are shaping up.
Hey guys, welcome to the 25th episode of the Indian Market Story. We're here with our returning guest, Mr. Dipan Mehta, to talk about a very, very interesting subject. Infra and construction companies. As you all know, one of the big benefits of the Modi government has been the amount of money that has been spent on infrastructure. And that's something we can see every day in our daily lives. But the biggest beneficiaries of this infra spending have been the engineering, procurement, and construction companies that are responsible for building the infrastructure that we use today. So, Mr. Mehta, please tell us, why should investors care about these infrastructure and construction companies?
First of all, Varun, thank you for having me on your podcast. And it's a very important sector in my opinion. And the reason for that is that India, there's a desperate shortage of infrastructure, be it roads, airports, ports, power plants, the works. There's a shortage of every single thing. And the nation is in the mood to construct a proper infrastructure so that the economy can grow. Right now, we are not able to grow above that 7.3% because there are infrastructure bottlenecks. The government has recognized that, and that is why infrastructure has been given higher and higher budgetary allocation, which is why I think infrastructure builders like EPC companies are very important from an investor's perspective.
Absolutely. So one really interesting thing that I wanted to highlight and get your thoughts on is over the last 28 years, the Nifty 50, our benchmark index for the stock market, has delivered 11.7% compounded. Against that, Larsen and Toubro, which is really the behemoth in the space that most investors will know, has delivered 16.4% compounded returns for investors. So why is this outperforming over such a long time frame, and is this one of the most important reasons it matters, or are we missing something?
See, Larsen and Toubro is in a class apart, and we'll talk about a lot about Larsen and Toubro as the podcast progresses. But excluding Larsen and Toubro, the EPC companies, they really haven't delivered any returns except in the last 3-4 years or so. And in fact, there have been so many accidents, mishaps, bankruptcies in the EPC business. It is really not, it's incredible. I'll just give you one small example, interesting. You know that Z promoters, they had to sell out of Z. Do you know why, Varun?
I know something to do with infra and real estate.
Yes. They started investing into infrastructure projects. Right. And that is how they lost the jewel in the crown, Z Telefilms, Z Entertainment. So the same thing goes with GVK, GMR. You may not have heard of them also. Yesteryears, they were giants engaged in infrastructure, construction and operating infrastructure projects. But they also, got into a big mess with the banks in terms of NPA. So it's a very difficult sector, but nonetheless important.
So, it's funny you mentioned some of these companies, and I definitely know these names, and so do our viewers, because one of our podcasts, I don't think you remember, but it was on this exact subject about how companies that have got into too much debt to get involved in infra projects have not delivered returns for investors. Exactly. So for our viewers, please go and watch that podcast to understand precisely why this is such a difficult business to be in.
It is very difficult, and I think we should spend a moment to explain our viewers the nuances of why this particular industry suffered for so many decades and why it is doing well just now. And if we were to sum it up, it is because nowadays we are setting up our infrastructure projects far more sensibly. All the various risk factors, all the various aspects are covered, especially land acquisition, environmental clearances, and financial closure. So what has happened is that as of now, the last 7-8 years, infrastructure projects are being done within the time frame and within the costs. And that reduces the risks for these construction companies which are actually implementing.
Mhm.
Because what used to happen in the past is that they would be awarded a project, they would start to build on the project, and then there would be some government stay order or some financial financing problem or an environment problem, and the project would get stalled.
Mhm.
When the project gets stalled, the construction company has invested,
Mhm.
and therefore their working capital cycles go haywire. And then many times there would be disputes with the government on the design and the scope of work.
Mhm.
So we have learned a lot from the mistakes made from the beginning, last 20, 30 years on infrastructure projects. And I'm happy to state that as of now, we have really fine-tuned this entire system of setting up large infra projects. So the nation also benefits, and these engineering construction companies also have their day in the sun.
So that's really interesting. So maybe let's bring this down to our, what matters for our investors.
The companies.
Yes. So what companies should investors be looking at, both within the investable universe and outside the investable universe? And maybe we'll go into some of them to teach our investors how to value these companies appropriately.
So Varun, first of all, we're talking about companies, so there's no recommendations and each investor should do their own due diligence. But I've gone public to say that L&T, Larsen & Toubro, is a must-own stock. There's no parallel to L&T in the entire country. There are certain projects in the country which only L&T can execute, like the Coastal Road project.
Right.
Like certain projects in Jammu and Kashmir involving tunneling.
Right.
Large-scale projects can be done only by Larsen & Toubro. And this has been a company which has been around for now almost 90 years.
So before we get into L&T, let's define the universe of stocks that we're looking at.
Okay,
right? We'll
sure.
spend a lot of time on L&T because obviously it's the behemoth. It's one of the driving forces of the Indian economy. What else is there?
So apart from Larsen & Toubro, there are certain niche companies like NCC, ITD Cementation, and PSP, to an extent Patel Engineering, which also do infrastructure project construction, but they have a slightly different business model in the sense that they don't invest in the projects they are constructing. And there are companies like KNR, PNC, Dilip Bilcon, IRB, which apart from being engaged in construction of projects, especially road projects, they also end up as being investors in those projects under the Government of India's hybrid annuity model system of setting up these projects. So broadly, there are three classifications.
Great. So let's start with the behemoth in the room, the one that you described as a must buy or a must own, L&T. Now, I'm sure every investor is familiar with L&T, but maybe for the few that aren't, could you describe what L&T does or maybe how they're structured and give people a bit of a background into how L&T makes its money?
So as I said, I think L&T is one company, it's among the top 15 construction companies in the world. And the complicated, large-size projects within India can be done only by L&T. See, the one thing, Varun, that we need to understand that this is not a business which can be done by a MNC coming into India. So this business of creating infrastructure projects, that is roads, ports, metros, it has to be done by homegrown companies. And L&T is the finest example of a homegrown company. And because of its size, because of its caliber of its engineering skills, because of its balance sheet, it can take up really large projects, 20,000-30,000 crores also worth of projects, and execute within the time frame and the cost on which it was allotted the project.
Yeah. So I want to try and give our viewers a sense of the size of L&T.
Yes.
Just so that they get a sense of what kind of scale we're talking about and what kind of balance sheet size we're talking about.
Absolutely.
So they have a market cap of 4 lakh crores, which is immense.
It'd be more than 60-70% of all other EPC companies put together.
Absolutely. And we'll get into how it's bigger than everything else put together. But just to give a sense of its operating metrics, it has an annual revenue in FY23 of 1,83,000 crores. It operates with a 16% profit margin and is currently sitting on an order book of 4 lakh crores itself.
Yes.
So, and sorry, just one more thing. Against that, it made a profit of 12,000 crores, which is fantastic. So, do we want to talk about what drives growth for L&T?
So what drives growth for L&T, of course, is that from time to time we need to execute difficult large projects. That is where they are the only company which can execute it. So they get those projects. Also, L&T management has been doing two very sensible things. One is that they are focusing on the margin of profit for the projects. So low margin projects they tend to avoid. Where there's too much of competition, they tend to avoid. And secondly, they've been focusing on overseas market, especially Middle East. And that has diversified their risk because it's not just India, they also have Middle East. And I suspect that the overseas orders are large in size and they give better margins and higher return on investment as well. So they've got subsidiaries in all parts of the Middle East which bid for projects. And as you know, because of oil prices, there's a lot of infrastructure construction happening in the Middle East as well. So they're taking the opportunity of both these geographies. That's what makes them quite unique. They have a lot of value in their subsidiary companies, the technology companies, and the NBFC L&T Finance as well. And I think last 2-3 years, they have decided that they're going to get out of all the projects in which they have invested in. They may have invested in power plants and metro projects, road projects. They want to get out of those projects and focus on better capital allocation. And that's what puts them a class apart.
That's really, really interesting. So again, I want to try and give our viewers a sense of, what growth has looked like. Over the last 5 years, their revenue and order book both have grown at about 6% or so. Although it's very much worth mentioning that this is through COVID times and the last financial year's growth has been particularly strong. Let's talk about their growth going forward. Now, we know that there's a big push for infra spending. The government has made very large infra spending commitments, and one would expect that seeing as they're the only people in the room that can execute these projects, they're the only people that are going to receive the contracts to complete them. So do you expect this growth rate of about 6% on their order book to stay stable or accelerate, or what does it look like?
It will accelerate. And the point to mention over here is that we are entering election season. So that's when government kind of loosens its purse and they spend even more on infrastructure because they want to showcase to their voters the quantum of infrastructure they have developed. I mean, we all want better roads, better airports, better metros, better railways. And it's the government's responsibility to provide those services to us. So they are going to spend a lot more on these projects, and that's where companies like L&T and other engineering construction companies come into play. So I think that the industry's growth rates in terms of order booking as well as in terms of execution is going to enter into a new growth phase over the next 2-3 years or so.
That's really interesting, and perhaps the market is also pricing some of this in, but I want to get your thoughts. So one metric we frequently use in this podcast is price to earnings ratio. And that's because the Nifty has a long-term average of about a 20 price to earning ratio. L&T has a current price to earning ratio of 37.8, which is very rich, especially for its size. Is that because of the accelerated growth, or is this just brand name premium?
It's all three: accelerated growth, brand premium, one of its type company because of its size, and a lot of value in its subsidiaries as well.
Right.
So to an extent, optically, the price to earnings multiple ratio looks high. But if you compare the potential of the company, the growth that it can generate, I don't think that and value of subsidiaries, then I don't think that the price to earnings multiple is that high. And this is a quality management company which has learned how to manage its balance sheet over the last 70-80 years. I mean, there's hardly any parallel to L&T having survived in a difficult country like India for so many decades and yet prosper.
So that's really interesting to hear. One thing I want to once again point out for my viewers about how it's been such an outstanding wealth creator. Over 28 years, like we mentioned earlier, 16.4% compounded. And even over the last 5 years, 20% compounded. But the last year especially has been outstanding with a 58% return on L&T. And I think from what I understand of your analysis, of its ability to grow in the future. I really hope that this price performance for L&T continues for the next decades in the future.
It's a great value creator, and it is there in most portfolios of mutual fund managers and high net worth investors, small investors. So for all our prosperity, we hope that L&T does very well going ahead as well. And L&T Varun has got very high corporate governance standards. It's a very transparent company. It's a key company from the government and the country's perspective as well. And it'd be interesting to know that it doesn't really have a promoter as such.
Mm-hmm.
It is owned by the large part of the ownership is with the employees' trust, and then a whole host of domestic and foreign institutions, they hold L&T. So truly, it is India's company.
So I think it's a really beautiful way to describe L&T, India's own company, something that's driving everybody's portfolio. But maybe let's move on from L&T to the smaller players in the room who are really a fraction of L&T's size, but in themselves have a lot of interest to offer. So let's maybe start with NCC and those types of infra and construction companies. What should investors be looking at when they're looking at these companies?
That's a nice question, Varun. That L&T is all pervasive, but smaller companies, what should investors be looking at? So what I look at first and foremost is the order book position and how many years the order book position is compared to the revenues. So what we call it, the order book is 10,000 crores and revenues is 2,000 crores, then it is 5 times.
Right.
So that's the most important matrix for analyzing EPC companies. That is the order book position of the company.
For NCC, just to give our viewers some context, their current order book stands at 50,000 crores, which has grown at a 7.5% over the last 5 years. And their current revenue stands at 15,000 crores, which has grown at only 4% for the last 5 years, which gives us, to your point, an order book to revenue ratio of just above 3.5 thereabouts.
That's as good as it gets as well. So it's in line with what other companies are having, and it's in line with what an investor should expect, because typically the projects are 3-4 years old or so in any case, and they're all the time bidding for new projects as well. So that's the most important matrix that I'm looking for over here, apart from the normal ones like return on capital employed and operating profit margins. The second most important thing to look for in an EPC company is the balance sheet quality. Mm-hmm. And if they have too much debt on their books, then that's a risk factor.
So once again, just to highlight this point for our viewers, NCC seems to be faring relatively well with a debt of only 10,000 crores as against a revenue of 15,000 crores or a profit of 700 crores and an order book of 50,000 crores, just to put this debt number into context. And more importantly, this has only been growing at 0.57%, which is slower than the profit growth or order book growth or the revenue growth. Just to maybe put it into context, this is perhaps a company that's managing its debt well or has learned to manage its debt well.
Absolutely. That's why it has survived for so many years as well.
So one question I have when I look at NCC is, so just to compare it to Larsen & Toubro, it has a profit margin of just 10.8%, whereas L&T has a profit margin of 16.4%. And we look at some other EPC companies that have relatively healthy profit margins. Why is that the case, and is that a problem or not really?
Depends upon the complexion of the projects, and if there are low margin projects, then that could be the reason for it. But I think 10% is pretty much fine, and 16% of L&T includes the subsidiaries also. So I think L&T's EPC margins would be 11-12%, 10-11% thereabout. So the margin figure is fine for NCC and all the other companies which we are covering in this podcast.
Okay, that's very interesting to know. I guess my next question then becomes is, why is the market valuing this so cheaply? Because it has a PE of only 13.4. And okay, L&T is a class apart. But why is this company at the peak of an economic cycle, or as we're approaching the peak of an economic cycle, not even being valued at the same rate as the rest of the market?
So that's not true just for NCC. Across the board, a lot of the EPC companies are valued very attractively and very cheap, which is why I feel that they could be great outperformers going ahead, because the valuations are attractive and the earnings visibility is fantastic over the next 3-4 years or so. The reason why they are at quoting at such low price to earnings multiple is because of the track record. The fear that investors have lost so much money in such infrastructure construction companies in the past that that fear factor is there, which is what keeps these price to earnings multiple low.
That makes a lot of sense because if you look at the historical price performance of these companies as well, over the last 28 years, NCC has only delivered 10% compounded,
Yes, yeah.
which is much underneath its peers as well as the index. Although the last year has been very good with the price almost doubling and it's returning a 93% return.
That's right. And also the return on capital employed now is looking up, but last several decades have been very low.
Right. So I guess that explains, NCC and its particular troubles. Let's move on to the other set of companies you mentioned. Let's look at two companies that look relatively similar, PNC Infratech and KNR Construction. So what do they do? What drives these two companies?
So while NCC also does water projects and is focused on different types of projects, including housing projects, PNC and KNR are road builders. Okay, and constructing roads, highways, bridges is not that competitive. It's very competitive, and it's not that high tech, nor is it that difficult to do. So therefore, their margins also will be pretty much on the lower end. At the same time, there's a lot of competition, and they are susceptible to delays because of what I told you about earlier in the past, especially acquisition of the land. And most importantly, the common thread between these two companies and 3-4 others, which we can also talk about, is that they are executing hybrid annuity model projects. And if I can explain that for a second.
Yeah, sure. What exactly is a hybrid annuity project?
So the government decides that they want to build a highway, and they give the onus of managing that highway, including raising the funding, to these EPC companies. So the EPC companies are required to invest their own capital and take on debt to construct the highway, and then they get certain benefits in terms of collection. So the government will subsidize them, or it will allow them to charge a higher toll.
Mm-hmm.
So the whole project gets operational in the books of the EPC company, and then they try and sell it to a financing company or to an investment trust. So the risk of the project goes from the government to these companies. So you can imagine, Varun, that that's quite a risky proposition. Don't you agree?
Yeah, absolutely. And I guess, you can see how that proposition is played out. Because let's maybe look at their figures for a second, just to give our viewers some context. PNC has a revenue in FY23 of nearly 8,000 crores, and KNR has a revenue of nearly 4,000 or so crores. But both have grown in a very healthy manner. PNC has over the last 5 years grown at a compounded rate of 16%, and KNR has grown at a compounded rate of 12%. But we discussed how we have to put the revenue growth in context of the order book. So let's maybe give our viewers a sense of that. The order book for PNC stands at 15,000 crores, so only 2 times the revenue. And for KNR, the order book stands at 8,800 crores. Once again, 2 times revenue. So that's different from what we discussed earlier, NCC as well as L&T.
Yeah, that's right, because there's only so much of capital which is there with these companies to execute these HAM, hybrid annuity model projects. And that's the reason why perhaps they have slightly lower order book position. But the basic business model is a little bit more risky than NCC, L&T, and some of the other companies we will talk about.
So I want to ask a further question here, right? Because you mentioned that these projects sit on the balance sheet of these two companies. The debt burden for PNC Infra is at 8,000 crores, which is higher than the companies we've discussed previously. And it's also been growing at a clip of almost 10% over the last 5 years. KNR is a little bit better. That debt burden is only 1,500 crores, and it's only grown at 2% over the last 5 years compounded. How important is this debt burden? How much of a drag is this debt burden?
See, this debt burden also fluctuates a lot, because supposing a project, HAM project, is completed and they sell the project, then automatically the debt comes down. So let's not focus so much on the debt or so much on the profit margins. It's important for investors to understand the business model is slightly more risky than some of the other companies which are in the industry.
No, that's very interesting. But again, I'm going to try and maybe give a different perspective on this because the figures suggest something slightly different. You talk about their business models being risky and how investors should be careful. But I just want to try and point this out. PNC Infra has over the last 8 years delivered a compounded return of 19.5% to investors. And KNR has delivered a compounded return of 33% over the last 15 years. So should we maybe look at it from a different light? Like, I get that they're risky, but the numbers suggest that they're fine.
You can thank Mr. Nitin Gadkari for it, because he's the one who's really been pushing road projects, highway projects, and these companies really have benefited from that. But I would say that it's a crowded space as well. And because they are investing in the projects themselves, there are certain limitations.
So very, very interesting. So I think that brings me to the end of the list of companies I wanted to discuss today. We also have ITT Cementation, Patel Engineering, and several others that you mentioned. Maybe let's take them all together and try and explain the rest of the infra and construction space, and how should an investor look at an infra and construction company from start to finish.
So I would want to talk about ITT Cementation because they are not into road and bridge construction. They do marine projects, they do metros, which is very different from the KNRs and the PNCs, and clearly they do quality projects. And again, this is a company with a very sound balance sheet and a very strong promoter and very high corporate governance standards. So it is one of the picks, I would say, of many investors in the stock market. PSP projects, Patel Engineering, slight differentiation in the terms of projects they do. PSP is more office buildings. That Surat Diamond Boss has been constructed by PSP projects. Patel Engineering is a lot into road projects as well as into tunnels and water projects. So each of these companies has got certain specialization because of their track record, and they are basically banking on such projects to deliver higher growth for them.
Right. So I guess I'll reiterate my question. I'm an investor. I'm looking at, say, ITT Cementation or Patel Engineering. How should I look at this company?
First, I look at the track record, Varun, because good times are fine, but these are also cyclical businesses, and companies which have done well when the times are really tough for the industry make for good long-term investing. ITD Cementation, Larsen and Toubro certainly come to mind, to an extent NCC also. How an EPC company manages itself when it's crunch time is very important, point number one. Second, of course, we discussed about the order book position, order to revenues. That's the second important matrix that I look at. And third is the capital allocation policies of the company. And it should not have too much debt on its balance sheet.
This is very interesting, and I think hopefully our investors will take everything that you've pointed out to them in account before making any investments. Now, I know that we're fully covered by a disclaimer, and our investors will see it at the end of this video. But for someone that's maybe doesn't want to put all the effort in, or is relying on the expertise of someone like yourself, how should they approach this sector? How should they allocate it in their portfolio, and what kind of stocks should they be considering?
Varun, that's a very interesting question. We never talk about the allocation of the industry in a portfolio. And perhaps we should, because that's one of the important decisions of an investor. In my opinion, I would put anywhere from 15 to 20% allocation in the infrastructure sector, and as high as 5% allocation in Larsen and Toubro.
Oh, that's very high. I don't know what the Nifty number is, but I think the Nifty allocation to infra is not as high as 20%.
But it's an outperforming sector, and I love the way the order book positions are shaping up. It provides a lot of visibility. And in the beginning of the podcast, we spoke about how the risk factors around constructing infra projects has come down because all the aspects have been covered by the government. That point has not been fully appreciated or discounted in these stock prices.
That's very interesting. So if you were, again, I'll mention we have a disclaimer at the end of the video. Please do your own research. But what stocks should investors be considering other than L&T to be putting in this 15% allocation in their portfolio?
So all of these companies we spoke about, we chose the best of the companies. There are at least 10, 15 more companies in the EPC space, but all of these companies you could have equal allocation and 3% of your portfolio, and that would easily outperform the market over the next 3 to 5 years or so. One last caveat here, Varun. We have a very big election in May 2024, and hopefully if the same government comes to power, these companies will do even better over the next 3 to 5 years. Otherwise, you have to just kind of reassess your investment argument.
Just closing the loop on the stocks, what stocks should investors avoid?
Oh, I think at this point of time, whichever stocks they are to avoid, they no longer exist or have become penny stocks. So that's not relevant. All the EPC companies which are listed are, I would say, investment grade at this point of time. So you could look at all or any of them. I think they are pretty much the same. As I said, order book to revenue, debt, track record. That's it.
Fantastic. I think on that note, we're going to close the podcast. Please remember our key takeaways: 15 to 20% of your portfolio needs to be in EPCs, and almost anything in the listed space is perfectly good to invest in, but you can't miss out on L&T.
Absolutely.
Thank you so much for joining us. We really hope you enjoyed this podcast, and we hope it adds value to your portfolio.
This podcast is produced by Elixir Equities Private Limited, a SEBI-registered research analyst. Registration number INA00004787. The information provided in this podcast is for educational and informational purposes only and should not be considered as investment advice. Investment in securities market are subject to market risk. We strongly advise all investors to read all related documents carefully before investing.